Two investors, same year, same market. One of them is sleeping fine. The other is refreshing financial headlines at 2 a.m., convinced everything is about to collapse. Here's what's strange. They're looking at the same data, the same reports, the same numbers. But one of them is reading Goldman Sachs, and the other is watching someone on YouTube who read Goldman Sachs and decided to sell you the scariest version of it. That difference between the actual data and what content creators do with it is going to cost a lot of people a lot of money this decade. And today, we're going to fix that. Let me tell you what's actually happening. Every year, the largest institutional investment firms in the world, Goldman Sachs, JP Morgan, BlackRock, publish detailed forecasts about the next decade. These are 100-page documents written by teams of economists, analysts, and researchers who have spent their careers studying markets. And what do those reports actually say right now? Not a crash, not Armageddon, not the end of the financial system. They say something far less dramatic and far more useful. They say, expect around 7% annual returns for U.S. equities over the next 10 years. That's it, 7%. No collapse, no hyperinflation spiral, no Great Depression 2.0. Just a quieter decade. And here's the thing. Financial influencers took that same information, dressed it in fear, and turned it into content about why you should panic. Because 7% doesn't get clicks, crashes do. So let's actually understand what 7% means, and more importantly, why it matters more than anything else you'll read in a headline this year. Think back to the last decade. If you were invested in U.S. equities from roughly 2010 to 2020, you experienced something historically unusual, returns averaging close to 12 to 13% annually. That wasn't normal. That was a combination of historically low interest rates, a technology revolution, and an almost uninterrupted economic expansion. It was exceptional. And the data is now telling us that era is over. Not because something broke, but because things normalized. Corporate earnings are still expected to grow. Goldman's models project around 11% earnings growth. But here's where the math gets interesting. Valuations, the price investors are willing to pay for each dollar of those earnings, are expected to compress by roughly 4%. Put those together, and you get approximately 7%. Growth minus expensive pricing equals a more modest return. This is what professionals call a normalization, not a disaster, a correction toward historical averages. The S&P 500 has delivered roughly 7% real returns over the very long run. We are returning to that baseline. And that baseline, compounded over 20 or 30 years, still builds serious wealth. But nobody makes viral content about baselines. Now here's the part most people miss. The reason markets are expected to deliver lower returns isn't weakness. It's actually the opposite. Markets are expensive right now, and they're expensive because the companies inside them, particularly in technology and artificial intelligence, are genuinely extraordinary businesses. Let me show you what I mean. When investors say a market is overvalued, what they mean is that the price people are paying today is high relative to the earnings those companies produce. The price-to-earnings ratio of the S&P 500 is currently well above its historical average. It sounds alarming on a headline, but consider this. In 1999, people said the same thing about technology stocks. Some of those stocks crashed, but some of them, Microsoft, Amazon, Apple, went on to become the most valuable companies in human history. Calling something expensive doesn't tell you when it stops being expensive, or whether it ever does. Expensive markets can stay expensive for decades. Timing the top is a loser's game. The investors who sold out of tech in 2017 because valuations looked stretched missed one of the greatest runs in market history. Valuation is a signal about return expectations, not a timer for a crash. But there is a real risk buried inside this story, and it doesn't get nearly enough attention. Right now, approximately 10 stocks represent close to 40% of the entire S&P 500 index. 10 companies out of 500 controlling nearly half of your portfolio if you hold a standard index fund. This is called concentration risk, and it matters because those 10 companies, mostly large-cap technology, are all exposed to similar forces: regulatory pressure, interest rate sensitivity, AI competition, geopolitical friction. If something disrupts that cluster, not the whole economy, just that cluster, the index feels it dramatically. This doesn't mean you should sell your index funds. It means you should understand what you actually own. And it means the argument for broader diversification, international equities, small caps, real assets, is stronger right now than it's been in years. Not because the US market is going to crash, but because concentration, by definition, reduces your margin for error. And this is where the conversation changes. Up to this point, we've been talking about returns, about valuations, about market structure. But there's something else sitting in the background of every institutional report right now, something the 60-second content creators rarely explain properly. 3 specific risks. The first is government debt. The United States is running deficits that are, by historical standards, extraordinary for a peacetime economy. At some point, nobody knows exactly when, the cost of servicing that debt becomes a drag on growth. It raises the probability of either higher taxes, reduced government spending, or a slow erosion of purchasing power through inflation. None of these outcomes is a catastrophe, but all of them are headwinds. The second is supply chain fragility. The pandemic exposed how deeply interconnected and how brittle global supply chains had become. The world has been partially restructuring those chains ever since. That restructuring is expensive, it adds costs, it slows efficiency, and it creates ongoing volatility in certain sectors. The third is what the reports call monetary uncertainty. The era of near-zero interest rates that defined the 2010s is over. We're in a new regime, higher for longer, and nobody, including the central banks themselves, has complete certainty about how this plays out across a full economic cycle. These are not reasons to panic. They are reasons to build a portfolio with more resilience, more cushion, more deliberate thinking about what you hold and why. Now here's the most uncomfortable truth in this entire video, and I want you to really sit with this. If you miss the 10 best trading days of any given decade in the stock market, just 10 days out of roughly 2,500, your returns get cut nearly in half. 10 days. That's what the data shows consistently across multiple decades and multiple markets. And here's why that matters. Those 10 best days almost always happen during periods of maximum fear, during crashes, during crises, during the exact moments when the financial headlines are screaming their loudest. The people who panic sell during volatility don't just lock in losses, they miss the recovery, which means they pay twice, once on the way down, once on the way back up. Think about that. The 7% annual return that institutions are projecting for this decade assumes you stay in. It assumes you are present for the bad days and the good ones. The investor who sits in cash waiting for the perfect entry point, the one the crash predictors keep promising is just around the corner, doesn't get 7%. They often get less than inflation. And they spend years of their life anxious, watchful, waiting for a disaster that either never comes or comes and goes before they respond. So what does the actual playbook look like? Not the panic playbook, not the influencer playbook, the institutional one. The one the people managing billions of dollars in pension funds and endowments actually use. It starts with accepting the return environment as it is, not as you wish it were. If 7% is the realistic expectation for the next decade, then the job is to capture that 7% as efficiently as possible. That means minimizing costs, low-fee index funds and ETFs, avoiding active funds that charge 1 to 2% annually and statistically underperform their benchmarks over time. It means genuine diversification, not just owning 500 US stocks, but thinking about international exposure, different asset classes, and assets that behave differently under different economic conditions. It means maintaining liquidity, keeping enough accessible, stable capital that market volatility never forces you to sell equities at the wrong time.
Your emergency fund isn't dead money. It's the thing that lets your investments stay invested. And above everything else, it means deliberately ignoring the noise. Not because the noise is unimportant, but because acting on the noise is reliably destructive. The investors who build wealth quietly, consistently, and without drama are almost never the ones watching the most financial content. Here's where we come back to where we started. Two investors, same year, same market. One of them built their strategy around what Goldman Sachs actually said: lower returns, some risks, manageable uncertainty, stay diversified, stay invested. Don't wait for the crash. The other built their strategy around what someone said Goldman Sachs said: fear, urgency, a crash just around the corner, cash is king, wait for the perfect moment. 10 years from now, those two portfolios will look dramatically different. Not because one investor was smarter, but because one of them understood something the other didn't. That in investing, the game was never about finding the perfect market. It was always about surviving the imperfect one. The headlines will keep coming. The crash predictions will get louder every time there's a 10% correction. The influencers will keep turning 100-page research reports into 60-second panic content. That's not going to change. But you now know what the data actually says. A normalization, not a catastrophe. A quieter decade, not a lost one. 7%, unglamorous, reliable, compounding, building something real, while everyone else waits for a disaster that never quite arrives. If you want financial analysis without the doom and gloom, the kind that actually helps you make better decisions, subscribe. That's what we do here, every single video.